Everybody who's joined. I think there's 6 or 7 folks already.
Oh, great. Good. I didn't realize we already had some people in here. Well,
Yeah.
welcome, welcome. Yeah, if you
It's
guys
not like a
want
normal
to.
team, not like a normal team's call where everybody can chime in. So,
Yeah.
thanks for listening to us.
Yeah. Yeah, absolutely. All right. So, let's get started. For those
Cool.
of you that don't know me, and maybe some of you do, my name is Dylan, and I'm the client success manager here at Savvy. So, a big part of my job is to talk to you guys, talk to our investors whenever they first get introduced, kind of explain us and figure out if we want to work together. And then the other really big part of what I do is I market match, which just means I study markets all day. I'm looking for good markets, and I kind of work with investors to figure out which ones are going to work well with what they're looking for, and I get them connected with our agents. Um, a big part of the reason that we were doing this and we're kind of dipping into cost seg is because that's been a big conversation to come up recently. And I've had a lot of investors just asking, if we know anybody that can help, just asking about general questions. And so we've newly partnered with Connor, and he's part of a group called Cost Segregation Authority Partners. The whole goal behind this was to just help some of our investors, especially those that are trying to take advantage of the tax benefits this year, by just connecting them with like an experienced group that can kind of help them get to where we can close on a property and we've got a good idea of what we're doing. But yeah, that's a pretty good intro, and I can kind of, just kick it off and throw it back to you, Connor.
Sure. Yeah, I appreciate it, and thanks everybody for joining. As Dylan said, we focus specifically on cost segregation. That's our bread and butter. That's all we focus on every day. We're not an accounting firm. We are an engineering firm that really does just this. That's all we do is cost segregation day and night. Um, a lot of folks within the short-term rental space use cost segregation in order to offset their active income, and we're going to get into that a little bit more. That's one of the big benefits that Congress has actually allowed is an investment in a short-term rental is able to be used against active income as opposed to a passive investment. A little bit about myself and our company. Um, I have been in the cost tech industry for over 7.5 years. The company itself has done over 25,000 studies, saving billions in tax dollars over those years. We are, like I said, an engineering firm with a accounting focus. So we have accountants on staff that do all of our audit support and shape how we actually write our reports. And then within our firm, what we do provide is um, we provide the actual cost segregation report, and then we also provide all the tax forms that are necessary to file your tax return with. Um, we're engineers licensed in 48 states. And the company itself is based out of Linden, Utah, but we do have a national presence across the entire country. Um, I personally am in the Southeast. That's how I connected with Dylan and Savvy in order to help their clients. So, what is cost segregation? That's kind of where we like to start with everything. Cost segregation is a tax benefit that the IRS has allowed or that Congress has allowed to accelerate your depreciation deductions. So if you have a property, you're going to get depreciation deductions over the first 39 years, or 27 and a half years if it's a residential property. Um, with that, what you're able to do with cost seg is front load those deductions into 5 year and 15-year class lives. It has 7 as well, but that usually has to do with data connections, and most houses nowadays don't have data connections. They're running on Wi-Fi. So, um, what with the accelerated deductions, it's all about the time value of money. So most of you guys can remember pre-COVID, 100 grand was worth exponentially more than 100 grand now, and that's exactly why cost seg is important because 5 years down the line, we don't know what's going to happen. Um, and if you're able to take that money now and reinvest it and make money with it, it's going to be worth more than taking your 139th or 127th over the class life of the actual property. Um, the whole goal is to improve cash flow, so free up capital. If you're not paying the IRS, what are you going to do? Most folks that are active investors are going to actively invest. So most folks are going to use their tax savings to improve their houses, improve their investments, buy another one, um, or we've seen recently with a lot of these bridge loans and a lot of these higher interest rates, people have been using the money to actually service their debt. Um, we use detailed engineering-based methods. So the IRS has approved 7 different cost segregation methods. We focus on 2. So we focus on an engineering-based report. If it's an acquisition, we go in, look at all of the assets, look at the house as a whole, and we price out all of the different assets via line item, and we ascribe a price to them, which gives that justification for taking the 5, 7, or 15-year class life. If it is a new construction, we tie out engineering wise still to the exact same basis that you paid for the new construction or renovations. I do want to say, if you have any questions, please throw them in the chat. Dylan, you feel free to interrupt me if we have a relevant question. We'll have time at the end, but these discussions are much better if we if we have active communications. If you have something in mind that's been eaten at you about cost seg or about depreciation, please ask. If I know, I'll tell you. If not, I'll get you an answer.
Hmm.
So with short-term rentals, and this is where Savvy and CSA kind of cross paths. With short-term rentals, you're able to use the deductions against your active income, assuming you hit one of 7 criteria. Okay, and that'll be on the next slide, I believe. But there are a couple prerequisites. Number one, you have to have an aggregate average stay of 7 days or less to have the property be considered as a short-term rental. So you can have a 30-day stay, and then you can have 31-day stays. It's going to average out to under a 7-day average stay. Unlike long-term rentals, short-term rentals aren't passive activities. So if you own single-family homes that you rent month to month, those are passive activities. Unless you have real estate professional status, there's realistically not a way for you to use those deductions against your active income, your W-2, 1099, whatever type of income you actually have. They're treated like a hotel, so it's depreciated over 39 years, not the typical 27 and a half for residential properties. Um, and then as I mentioned, you have to hit one of the 7 material participation tests. And here they are, I believe. The easiest one and the most common one that folks hit is this one right here. 100 hours, the second one on there, 100 hours and at least as much as anybody else. So, um, most people will buy a property that they plan to use as a short-term rental. They'll position the property in order to get the property ready to rent, get the property ready to place onto the market, and they spend a lot of time doing that. I always talk to people and they're like, well, 100 hours is a lot. I'm like, is it though? Is it really that much? If you're spending time furnishing it and you're looking at you're spending time, looking at home goods and looking at Home Depot and going to Lowe's and figuring out exactly what tiny renovations or what fixes you need or what appliances you want to put in. Log that time. If you log that time, then you have a defensible position that you're spending those hours on your property. Um, the 500 hours at the top there, that's probably not realistic for most investors. Most investors probably aren't going to be that involved on their short-term rentals. They're vacation homes that they're going to try and make income on throughout the year, as well as use to some extent. So 500 hours probably isn't realistic. the 5 of the 10 years portion is doable, but it's also, how often are you going to wait 5 years or 10 years to try and take deductions on your short-term rentals? Um, that kind of defeats the purpose of time value of money. At that point, you've already been set back 5 years or so. Um, and there's a couple other ones, but as I mentioned, the main one, and I would say probably 90% plus, go for the 100 hours plus and at least as much as anyone else. Anyone else does include contractors, uh, cleaning people, property managers. So you really have to log your hours, and ask them to also, just give a rough estimate, give an idea of how long they're spending on the property. So then you can compare, make sure that you are at least as much as them, to qualify for the material participation.
Connor, we do have a question that just dropped in the chat.
Sure.
Um, so somebody asked, how long do we need to run as a short-term rental to take max depreciation and W-2 write-off?
Um, Good question. Technically, it comes down to intent with the IRS. So if you buy a property in December and you intend to use it as a short-term rental and you are able to get the material participation portion checked off, technically it's a year-to-year test. So once you do it the first year, you qualify. Um, you would be able to take those deductions. It's not like you get a percentage of deductions. It really comes down to a year-to-year test. Um, that being said, it all comes down to intent with the IRS. So if you have that, um, if that is your plan and your goal, and then the next year you decide, oh, short-term rentals are too long, and then or too hard or too time consuming. I'm gonna make it month to month. Well, then the IRS says, well, your intent was actually to have a long-term rental, and you need to pay back that depreciation. So that's kind of where it gets broken down. If you're intending in goodwill to have a short-term rental and you're trying to meet the requirements, the IRS is not really going to mess with you as long as you're logging everything. It really has to do with when people are using the loophole in order to take advantage and then take advantage a second time. That's where you run into problems. But yeah, December properties, later in the year purchase properties. Like I said, it comes down to intent. If your intentions are good, then you're probably going to be able to participate and take advantage of it.
Okay, that's great. And then we actually had another question right after that.
Sure.
For MP, does anyone else mean each individual alone or an aggregate of everybody else?
Say that again. Sorry, I didn't hear.
Yeah, yeah. Well, and I wasn't sure. I might have missed that. What MP stands for? But the question was
Multiple
for.
partners, I think.
There we go. Yeah, that's definitely it. Yeah. So for multiple partners, does anyone else mean each individual alone or an aggregate of everyone else? Oh, material
Good question.
participation. Yeah.
Yeah, good question. I don't know the answer to that. I've ran into this multiple times, and multiple times, multiple of the partners have had real estate professional status, so we haven't actually had to dive into the case law. Um, Good question. I will get you an answer. I'm not exactly positive.
Okay. Sounds good. That's all we got for now.
Okay. I'm gonna skip this. It just talks about what participation means. Spouse's participation counts as yours. It's a joint return. Um, Talking about what actually you are doing on the property. Reasonable methods accepted for taking your hourly total. So, calendar, appointment book, just explaining where you spend your time. As long as you have it written down, that's what the IRS is going to look for. And I don't want you to think that, the IRS is checking 100% of short-term rentals. This is, of the Um, if you ever do get checked, you want to have this justification, but it's not likely that it's something that's going to come up. But you do need to have the justification.
I think that you were right about the 100 hours. I think that that's the category that most of the investors are going to fall in, and it's really not that hard. I mean, just like imagine how much time you spend looking at furniture. So, yeah, thanks
Right.
for going over that, Connor.
Yeah, of course. When you're looking at properties, there's some things that you should look for, especially if you're trying to maximize your depreciation deductions. So, this is kind of a breakdown of the 5 year, 7 year, 15 year, and then what gets left in building. So, if you kind of think about it like this, where what could you take with you? What could you take with you, and the building still function as a building? Um, you could theoretically take the carpet, you could take the countertops, you can take the cabinets. Window coverings aren't needed to function as a building. Um, and people have proven that you're able to take these things and the building would still suffice. Um, That being said, you can't take things like you can't take the bathroom, you can't take the toilet, you can't take the sink, for instance, because you need those assets there in order to even hit code in the first place, in order to get a CO in the first place. So when we're talking about property reclassification, we're talking about the 5 and 7 year. That's personal property, what people often refer to. That's going to be things like carpet, countertops, cabinetry, wood flooring, panel flooring, luxury vinyl. The only flooring that does not count, and for folks that are looking at the beach, this is very important, especially condos. A good portion of your benefit comes from your flooring within condos, and tile flooring does not count as a 5 year asset. Nobody's proven that they could scrape up tile and move it to another property. So, something to think about, especially if you're trying to maximize deductions. If you can find an LVP, a condo unit with a luxury vinyl, they have the luxury vinyl tiles; those count. But the actual tile itself, ceramic tile, does not. Um, and then the benefit of a property actually breaks into two different parts. So land improvements and personal property. So the personal property is the stuff on the inside of the house, and then the stuff on the exterior is where you get your 15 year. Both of these are eligible for bonus. So the 5 year, 7 year, and 15 year are all eligible for bonus. And we'll touch on bonus in just a second. It's probably the single most important thing when it comes to cost segregation for residential properties or short-term rentals. Um, so if you're thinking of a suburban home, you're going to have a driveway, you're going to have some amount of sidewalk, whether that's yours or the city's. That depends on the property. You're going to have a fenced-in backyard potentially, or a fence around your property. Um, maybe you think of a deck out back or retaining wall. Any type for the folks in Florida, you're probably going to have an irrigation system. Um, the all even the trees. I mean, trees and flowers, any type of landscaping done, you're able to take. So sod, for instance, is the per square foot price of sod is $2 or $3, but it adds up, and that's essentially what you're getting with the cost seg report is a list of every single asset that you purchase within your 300, 500, 750,000 $1 million property, and then having those assets listed and factored up to what you actually spent. Um, that's the benefit of the cost seg. And it also helps outline exactly what's there because a lot of times with short-term rentals, sometimes the tenants aren't the best. Tenants will destroy stuff. Tenants will not treat your house as they would treat their own, or maybe they do. Maybe they treat their house horribly as well. But if you have a bad tenant that destroys your carpet, you're gonna have to replace it, whether that's insurance through insurance or you just pay out of pocket for the insurance or for the carpet. But when you do that, you need to be able to remove the assets that are already on your books and take them as a deduction, take them as a write-off because they're no longer in service. So by having everything outlined at the front, not only do you get a front-loaded depreciation, but you also are able to manage your property as a whole better throughout the entire life cycle of that property. All right, bonus depreciation. This is I'm so happy because I was around in the industry during the 2018 boom when it came to the real estate market. And most of that, a good portion of that was due to bonus depreciation. So, what is bonus depreciation? Bonus depreciation has been around since the beginning of cost seg, but specifically it's been around for newly constructed properties. Prior to 2017, it was never available for acquisitions. With the Tax Cuts and Jobs Act in 2017, they opened it up to acquisitions, and the rule essentially is any asset class life that's under 20 years, 20-year being, I believe it's amusements. So I think like Disney rides are considered 20-year assets. So any recovery period under 20 years or less, so that 5, 7, and 15, you're able to take some percentage of those deductions up front. So historically, if we were to move, and I'm just going to use a whole number, if we have $1 million property and we were to move 30%, you would have $300,000 in deductions broken up over the first 5 and 15 years. So some portion would be over 5 years, some portion would be over 15 years, and the rest would be left in 39 year. With bonus depreciation, what we're able to do is of that 300,000 that we moved, you get to take a percentage of it in the first year. So why that's important is that $1 million investment that you just made in a short-term rental or in a property, those $300,000 in deductions, it if you acquired or went under contract after 1/20/2025, you're going to be able to take all 300,000 in the first year. I mean, that is a massive, massive tax benefit. So, assume you have a 30% tax rate, you're essentially getting 10% minimum of your investment back in tax savings. There is recapture, and we can if anybody has questions on recapture, I can try to attack them. It's a little bit nuanced, but if you're buying a property and holding it for a decent amount of time, caustic probably makes sense, especially if you're an active investor. So, looking at the Tax Cuts and Jobs Act, and this is what we've been dealing with for the past 3 or 4 years. As of 2023, the bonus percentage has been dropping 20% per year until it's zero in 27. Um, that being said, the OBBBA is now a permanent 100% bonus. Um, and the only caveat is the property has to have started construction after 1/19/2025 or started construction or gone under contract for the construction actually. And then the acquisitions, the purchase sale agreement, or when you went under contract for the property has to be after that 1/19/2025 date. So that's kind of where we're at now. We have a lot of folks that bought properties in December and January
Mhm.
that didn't hit the threshold according to the way Congress wrote the actual tax law, and it sucks. It sucks, but it's just kind of how it is. The same thing happened in 17 and 18 where some people got caught up with just an unlucky closing date or unlucky contract date. Um, but anything purchased after, anything under contract after that 120 date will get a 100% bonus. Um, any questions there?
Yep. Any questions, anyone?
Okay. This
Oh,
is
yeah.
super important with cost seg. I get this all the time. A lot of folks think that if you don't do a cost seg in the year you purchase the property, that you lose the chance to. That's it. If I bought the property in 2022 and I didn't do a cost seg, that's it. I lost my opportunity. That's not true. What we can do is a catch-up study. And what that looks like is a study on the property as purchased. And we essentially generate the report as if we wrote it in 2022 and trigger what's called a 481A adjustment. So this does require a couple of extra tax forms. The 481A adjustment has to be calculated, and you have to file what's called a Form 3115. We include those in our fees. A lot of times that is an extra fee. So if you're shopping your Cossack around, just make sure you know that you're going to have a 41A adjustment and a 3115.
Mhm.
Um, that being said, you can catch up. I mean, I just sent out a proposal for a property that was put in service in 2004. So, I mean, 20 years ago now, 25, 20, 22 years ago almost. Um, that's you can catch up as long as there's still depreciation left. Um, Partial asset dispositions, this is something that really it's really more, it's more for larger developers. So think of like a hotel where they're going to have to replace their roof or replace every vanity according to their flagships. So when they do that, what you're able to do is actually take the value of what's on your books and then continue depreciating it as long as it's not a betterment. So, for instance, you replace your roof, you have your roof outlined in your original cost seg study, you replace your roof 3 years later. There's potentially a way, and like I said, there's a little bit more nuance to it, but there's a way to not actually capitalize the second roof and just continue depreciating the original as long as it's not a betterment. Then tangible property regulations. Most of your CPAs are probably doing this for every single thing that you purchase for for your home, for your rental properties. So you're purchasing a toaster, you're purchasing, uh, I really spoons and forks and plates and stuff for the bedrooms and a steamer and when you're purchasing those small things, they essentially get caught up in what's called the de minimis safe harbor. So anything under $2,500 is able to be taken via de minimis safe harbor. So that stuff is probably being expensed by your CPA or by your tax preparer already. Um, but it's good to know about for some of the larger items. So, um, say for instance, you have a pool and the pool needs to be fully refinished, or the pool needs to you need to tear up the deck and build a new deck. Well, when you tear up that deck, you're potentially going to be able to write off the existing deck, and then take accelerated depreciation on the replacement.
Mhm. I've got a couple of chat questions for you.
Sure, what's up?
So, Monica is wondering, what if I acquired in 2013 and placed in service in 2024?
Sure. Great question. So what you're going to be tied to is the purchase price or the fair market value, whichever's less. I mean, it's real estate, so it's probably the purchase price in 2014, so or 2013. So that will be your basis. Because it was purchased in 2013, that's before bonus depreciation existed for acquisitions. So it won't receive bonus based on that. But you technically could look at it for cost seg. I don't think there would be enough benefit on that one because it really depends on what the basis is from 2013.
Hmm. Okay, that's great. And then we had another good one here. Uh, do you always physically go to a property to do the cost seg study?
So we don't. We during COVID the IRS allowed for virtual visits where essentially the property owner or the property manager or um, even sometimes we've had cleaners do walkthroughs with us where our engineer is on one side of the tablet and you guys or your property manager is on the other side. And what we're able to do through this software that we've created is walk through the property and take live video and photos. So it's when you walk into the property, we're going to say, can you turn your phone sideways? can you look at this wall? It takes live measurements of the wall. It takes photos of it. So if there's a window on the wall with window coverings, it's going to notate that. Um, and the entire time, a member of our engineering team is guiding you guys through the site. Um, we can do in-person site visits. It's just the same engineer that's on the other side of the iPad or phone that's going to be visiting the site. Typically, we don't necessarily need to, unless there's a very nuanced situation. So, say you have a quadplex and you have different finishes in each of them. We may want to visit the site in order to properly track everything. But if it's very straightforward, we're very, very comfortable, and we've had the IRS mention that they appreciate having a video to reference um, if they're looking at anything for audit. So we do most virtual for residential, um, commercial over 20,000 square feet. I know that's not kind of what the topic is here. Commercial over 20,000 square feet or so, we like to have our engineer visit the site.
Perfect. Awesome. Thanks, Connor.
Yep. Um, this is important for folks that are buying and plan to do renovations. Um, and admittedly, it is a very binary thing. When we're talking about qualified improvement property. Um, so what qualified improvement property is any interior non-structural renovation to a property that's already been placed in service. So placed in service by anybody, not placed in service by you. Um, it can be any taxpayer at any time. And this was brought about for property owners who own, think of like a retail space, and they have a tenant that's about to leave, and they're going to have to pull out all that tenant stuff and then attract another tenant. Well, how can they do that? Well, they can offer to do the build out. And if they do the build out, they get a tax benefit of qualified improvement property. Um, because short-term rentals are considered like hotels, they're commercial properties. So they do qualify for qualified improvement property. Um, I, admittedly, I am very aggressive when it comes to QIP. Um, and the tracking has to be very, very good. So having a taxpayer say that 100% of the renovation was interior is not enough to justify it in a report. We have to actually have invoices or something from the contractor or contractors or subs that says this is what I worked on. I rewired the entire house. It was only the interior. Not nobody, nothing was exterior. It was rewiring the inside of the entire house. So then an electrical line item that is maybe $30,000 is able to be taken under QIP, where it normally wouldn't be. It would normally be left in that building space. So if you're buying and renovating a property, you need to be aware of QIP, but you also need to be aware of what's needed in order to justify taking QIP. So you need a lot of detail when it comes to the renovations in order to justify it. So um, what does interior non-structural mean? Anything that touches the exterior, so exterior windows, doors, they're going to be considered structural. Elevators, escalators, enlargements. So if you expand the footprint of the building, it's considered an enlargement, therefore you won't get QIP for it. You can still cost seg it, but you're not going to get the blanket treatment that QIP qualifies people for. Um, so why is QIP important? It's a 15-year, classified as a 15-year property, and gets bonus depreciation. So looking towards 2025, if you spend $200,000 on the interior build out of a short-term rental, and you have justification, a good detailed justification of that interior build out, a good portion of that 200,000 is going to be taken in the first year. And that's a massive, massive, massive benefit to taxpayers that are willing to make the improvements to properties. So it's very important to kind of understand what QIP is, but it's also important to understand the tracking. It's just like the hours for tracking material participation. You have to have great notes and great records of your renovations and of all your work done in order to take advantage of it.
Great. How many slides do we have left, Connor?
That's
Oh,
it.
look at that. Called it. All right, and you know what? I also wanted to make sure, could we talk about recapture for a little bit before we close things
Sure.
off?
Yeah. Yeah. So let me go back to here. Yeah, there. Okay. So recapture is essentially, it's a tax that you have to pay because you took this early. So when you accelerate depreciation, you're taking the 5 year, you're taking the 15 year, you're taking the 39 year. Well, when you sell the property, typically if you just took a straight line depreciation, you would be paying capital gains whenever you sell the property. Um, when you take the accelerated depreciation, the 5 year, it's recaptured at ordinary income rates. So you're essentially getting a interest-free loan from the government by not paying these deductions or by not paying these taxes now. But when you sell the property, they do become due. Um, that being said, most folks are able to invest well enough to make up 10 to 15% on the money that they take. So if you're investing strategically enough, you're going to come out on top of this scenario almost every time. Um, this only the 5 year is considered recapturable for the 5 and 7 year is considered recapturable under ordinary income rates. The land improvements are recaptured at 25%. So there's only a 5% difference between these two, and then there's a 10 to 15% difference between the 5 year and the real property. So um, it's something that you need to consider and have an understanding of, but it's also something that you can avoid if you are open to 1031 exchanging, for instance. So if you 1031 out of a property, you're not only deferring the capital gains, you're deferring the depreciation that you've already taken. So there are solutions. Also, when you sell a property, the flooring and the carpet, the window coverings, they're not worth the same as when you purchased it or built it. So you're able to revalue some of those assets upon sale to mitigate that recapture. So it shifts the value back from the 5 year into the 39 year and land because that's really what's appreciating with the property.
Hmm. Yeah, and I've
Yeah.
got one clarification question in the
Sure.
chat. Okay, so it's about improvements outside of the house. You know, if you had a pool or a deck, can you
Yep.
cost seg those items?
Yeah, those would be
Certainly.
considered under these land improvements. So this is specifically for you can still cost like anything that you spend money on. I always say that as long as it's part of the building or part of the property as a whole, you can always cost seg it. We don't look at FF&E, so we're not going to look at your lamps or your beds or stuff like that. Your CPA typically has classifications for those. But for instance, say you put in a pool, like you said, if you put in a pool or a hot tub or um, you know a decked patio out back that's separate from the house, then you will be able to take them as 15 year with bonus. So the reason QIP is a little bit different is because it allows you to take some of these assets that are usually never part of the accelerated class lives and take them as a 15 year with bonus asset. So for instance, if you get all the ductwork fixed within the house and it's all encompassed inside the actual structure, that should be a 39 year asset if you did a standard cost seg, but because of QIP, it gets a blanket interior improvement treatment where it will receive 15 year treatment and bonus. So that's kind of the difference. But great question. Yeah, land improvements are always included. They're just included under this bucket.
Yeah, and QIP, very important. So we have about 20 minutes until the top of the hour. I really want to get a chance for you to walk us through that case study because I think that's going to be great for everyone to
Sure.
get a full picture. But really quick, let's just take a couple minutes. Do we have any general questions in the chat before we get to that case study? All right. Well, we'll give it some time. If one trickles in, we can stop. But yeah, Connor, we would love to see that. Oh, you know what? Hold on.
Yeah.
Uh, I've got a good one. So, one question. Uh, I just bought an Airbnb property this year. Which is the best time to cost seg, in your opinion?
Depends. Do you have a tax liability? If you have a tax liability this year, then the sooner you can get the money from the cost seg, the better, because it's like, as I mentioned, it's time value of money. So, we always say it's best to do it immediately if you have the ability to use the deductions. If you don't have the tax liability, there's no reason to do it right now. You're just essentially creating losses that you're going to be able to use in the future. If that's worth it, great. But most people want to actually see the benefit of the deductions at work. So I would just say if you have a tax liability and you qualify through material participation, probably makes sense to look at.
That's great. Uh, they should do FD improvements or uh, okay. Follow-up question. Should I do it after the improvements or before I make those? Probably after,
Depends.
right?
Are the
Oh,
improvements in the same tax year or are they going to be in the next tax year? We'll wait and see if we can.
same tax
Same
year.
tax year, wait till
Mhm.
after the improvements are done. If it's a separate tax year, you have the ability to look at what you purchased essentially. So it's a way correct, I believe. And so when you purchase a property and then you wait till a separate tax year, your intent, according to the IRS, is that you intended to use the property as is and then decided to make renovations. Um, if you do the changes in the same tax year, the intent, according to the IRS, is that you purchase the property with the intent to fix it up, add market value to it, and because of that, you don't get to take the original assets that you purchased. So if you're replacing the floors, they now have the existing floors have zero value, but the new floors will have value, or the new cabinets or new bathroom or whatever you do. So it really comes down to timing for a lot of the stuff. But in that situation, what we would do is essentially add your renovation to the acquisition cost, take the real cost that we can from the renovation. So if you had a line item for, say, appliances, we would take that actual cost and then estimate out everything else that we can't actually visibly see from the renovation costs. And that's kind of the process there.
Perfect. And then let's just do one more because I want us to have time to move on to this.
Sure.
Just confirming, material participation is only for short-term rentals. Schedule E rentals would not qualify.
I believe so. They do qualify if you have the ability to make those passive losses active losses. So if you or a spouse has real estate professional status, so if real estate is your bread and butter, um, and you're not making money from anything else, then yes, you potentially would be able to use that against your long-term rentals.
Perfect. Okay. And yeah, we've got I'd like us to move on so we can, get this case study done, but I don't want that to dissuade anyone from asking questions. So, guys,
Yeah,
feel
well,
free to keep asking.
I can stay on longer after to answer questions
That
if we want to just look at this.
mhm. I was thinking that's really good because there's been some really
Yeah,
insightful questions.
sure.
So yeah, guys, just keep throwing your questions in the chat, and then me and Connor will stick around at the end and kind of talk to you one-on-one.
Okay. Can you all see my window here? Are you able to see my screen?
Yes. Yep, we can see
Okay.
it.
Okay, so this is a scrubbed report. And this is essentially what you would get if you send me an address and say I purchased it for X amount, I'm placing it in service at this date. What does my depreciation look like? So this is because we have partnership with Savvy. This is completely free. We offer these for any properties that you're considering or have already purchased or have owned in the past. Um, so what we're looking at is this is kind of the property information. Um, Looking at a purchase from 9/1/2025. The bonus is 100% because it's a current year purchase. This basis, and I'm going to skip to this page because it's actually all the information. So this property was purchased for 920,000. You can see that right here. The land value, so depreciable basis is purchase price minus land. The land value we determined to be 165,000. So the leftover basis is right around 750,000. Um, Looking at this property, it's a 1,700 square foot property. That is obviously not the same property, and a 0.39 acre lot. We expect to move 32% to shorter lives. So this is very, very, very typical for suburban homes. We almost always find between 30 and 35% at minimum, upwards of 40 plus percent, assuming there's some type of renovation or maybe a nice pool or nice landscaping or dock or something like that. Um, but if we move that 32% based on the $750,000 basis, the first year deductions are going to be over $238,000. So the direct deduction of their against their taxable income is going to be $238,000. What that looks like at a 35% tax rate is about $83,000 in taxes you're not paying the IRS. So, I mean, this is very, very typical of a short-term rental property. If it's a $500,000 property or $375,000 property, you could literally cut this number in half. So 43,000, 40,000 or so. And first year tax savings, 110, 120,000 or so in first year deductions. It's scalable either way. If it's a $3 million property, you would, 3x that. So this is what you'll see. The property itself will be in the picture if we can get a picture. So we're looking at the right thing. It kind of keeps us honest and make sure that we're looking at the right properties whenever we do estimate. And then you'll be able to see, this is what we need from you guys on the in order to support the cost seg study. So we need an appraisal. If you don't have one, that's fine. Some people pay cash, they don't have a bank appraisal. Client info sheet. Anytime we close a project, we ask for information on the taxpayer, the entity, who the site contact is, and who the CPA is, and if they want them to get a copy of the report. And then the settlement and closing statement. Um, and then we also discuss next steps and then what's included with our reports. If we go to the next page, you'll see this is a breakdown of exactly what that benefit looks like. So if you look on the left side here in the gray, this is straight line. This is 27 and a half year straight line every year. And I know this isn't a short-term rental, but same concept. Every year for 27 and a half years, they're getting $27,430 year after year. If that's enough in deductions to offset your taxable income, perfect. You don't need to do a cost seg. That's it. A lot of people, their deductions suffice. They don't necessarily make enough to need to do a cost seg. But for those of you that do have a tax liability, um, this is essentially what you're looking at. So based on the fact that we think we'll move 32%, that $238,000 in the first year increased depreciation, um, it looks a lot like this. So we're taking some from every single year for the next 27 and a half years in order to front load the 246,000 in the first year. So essentially what we're doing is taking that 246 the total less what they would already take in 27 and a half year. And that's where we get the 238 in first year increased depreciation. So with that being said, you see you're essentially giving up $9,000 a year for the next 27 and a half years, but you're getting 250 or so, 240 in the first year to invest now, and you're still getting 18.6 year after year. So a lot of people think, well, once I do a cost seg, I'm not getting anything. Well, no, you still have that 70% or so that's left in the 39 year or 27 and a half year. Um, and that's a really, really big portion. I mean, that's 512,000 of the entire basis that you'll still get over that 27 and a half for 39 years. Okay.
Awesome. We've got we've got a couple of questions. Well, really just one and a follow-up in the chat for you. So again, just to confirm, all of these deductions are recaptured upon the sale, presuming it's not a 1031.
Not all of them, a portion of them. So, like I said, the 5 year assets are recaptured at ordinary income rates. The 15-year assets are recaptured at 25%. So there's really not much of a difference there.
Mhm.
Um, and then the 39-year assets are just or they're considered capital gains. So yes, you'll have to pay a recapture on the 5 and 15. The 15 year is a small amount. The 5 year is ordinary income rates, but a lot of the assets that you have that are 5 years are going to be worth less when you sell the property. So a good rule of thumb is usually if you hold the property for 3 to 5 years, probably makes sense to do. And like I said, it really has to do with really has to do with how aggressively you're investing. So, um, if you're actively and aggressively investing, I don't know if it doesn't make sense. I would say it probably makes sense 99% of the time because you're going to make up that difference through your investments.
Okay, perfect. Here, do you
Let's
do you
see.
wanna pull up the chat so I don't have to read all of these to
Sure,
you?
yeah, I'm looking at it.
Okay.
Okay,
Yeah.
the previous owner did reno before I purchased. He did a 1031 exchange. I bought conventional. Yes, so when you purchase the property, the assets that he put into service. So previous owner did a renovation, you purchased the property. When you purchase the property, the depreciation for those assets restarts. So he did you a big favor, probably gave you a little bit more benefit by doing the renovation. You won't get QIP for the renovation, but the assets that you purchased are going to be probably worth more than if he hadn't done the renovation. So you do get to depreciate them, but you don't get to take the QIP. How much does a caustic study cost on average? It depends. I will, full transparency with you because if you reach out to us, it's on our estimates. We typically charge, I would say, for a normal single family home, or a condo is going to be a little bit less because it's square footage. We charge what our engineers are going to take hourly. So we're really just an hourly rate for our engineers. And most residential properties come in the I'd say 32 to $3,500 range. A condo might be a little bit less. If you have a $10 million compound, it's gonna be a little bit more. It's all square footage, and it's all billable hours by our engineers. The IRS has made it very clear that you cannot charge based on um, how much benefit we're going to get. So we can't look at a project and say, "Oh my gosh, this is a home run," and then charge much more than we would for a regular single family home. So I hope that helps. Probably if I had to guess, in the 32 to $3,500 range. And we shoot for 10x minimum ROI across every study. So, if you have a property that's $150,000, I will be very honest with you and say probably doesn't make sense right now. It might. We can look at the numbers, but probably doesn't make sense. If you have a $500,000 property, it probably will make sense because you're just taking essentially 30% of that 500,000, and then applying your tax rate to it. If you do a cost like on a 20 unit and then I sell 3 to 5 years later, will you do a reevaluation of the 5 year property at sale? Will that be an additional cost? Yes, we do the reevaluation. It's not the same type of evaluation that determines the original evaluation of the asset. So when you do a cost seg, you're using an aggregate purchase price of assets across the entire country. So you use a laminate floor. We're taking an aggregate of New York, California, Florida, Alabama, Ohio. We're taking we're essentially taking what's called RS means and ascribing a price for each asset. When you sell the property, it's completely different. We have to use state and local tax rates and state and local resources to find what the salvageable value is of those assets when you sell it. So that carpet that you bought 5 years ago, what's the salvageable value now? It's probably 10 to 20% of what you paid for it, or 10 to 20% of what the basis is in the property. So it's a little bit more in depth. Um, it is a separate study. We call it actually a 1245X study. So 1245 exchange, we're shifting the 1245 property back into building and land. Um, I would say if the basis is high enough and you've held it for 3 years, probably worth exploring. I mean, it's the same type of estimate of benefits.
Mhm. These are awesome questions. We got any more
Yeah,
questions from
great
anyone?
questions.
Hmm. Well, we'll give it a minute. But yeah, we did great. We did this whole hour. So thank you so much, Connor. That was really, really
Yeah, of
insightful
course.
and really appreciate you having you on. So what I'll do right now, um, I'm gonna send a link to my calendar in the chat and I'll send your email. Oh, we still got more questions, Connor. Keep going.
Yes, it's very similar.
Okay. And it's Connor at csap.com.
Yeah, Conner
Okay.
at csap.com. Tyler, for those that potentially you want to look at 1245X, you have the important thing is in order to mitigate the recapture, you have to have the recapture. So if you had a cost seg done on the front end, we need to see the cost seg, and then we need to see what you're estimated to sell it at, and then what your estimated sale price is and what your tax rate is, and that's pretty much it.
Recording. Will you add your emails to the contact info on the recording that will be sent? Absolutely. Yeah, and I was actually gonna send that in here right now. So that's Connor's email. And this is all I'm gonna send this all out to you too. So don't feel the need to grab it now if you don't want. And I'm gonna send my email too. And I sent a link to my call calendar. So yeah, I know that this is a lot. Thank you guys so much for bringing in insightful questions. And, we thought this might only be 30 minutes. So this was a really good time. But yeah, if you want to talk more, just reach out to one of us. We're happy to talk about this. It's been really, really exciting getting things going for people. All right.
Yeah, 100% agree. Super easy to discuss your properties or plans, and I'm happy to get involved when you're looking at a property or after you purchased it, or if you plan to look at doing renovations. It really is good to discuss ahead of time to maximize exactly how that looks like, what that looks like, and how you can actually get the most return tax wise.
Mhm. Yeah, and for people
Yeah.
buying right now, I think that this is the perfect time to do it because I think there's going to be a
Yeah.
lot more people looking to do it later in the year. So, good job to
Right.
everybody on this call. You're being proactive. Looks like we had another question just popped in.
Yeah.
Oh,
Um, Yeah, if you do a cost seg on a short-term rental and someday plan to turn the property into your residence, does it make sense to do a cost seg? Sure, but when you turn it into your residence, that recapture comes due. It's the same as if you sold it. Um, so yes, you could do it if it'll help you, but you're not really going to have the proceeds of a sale to offset any of that recapture that becomes due. So I would probably say no. Um, Hotels do not qualify for the short-term rental loophole. I wish they did. They do not. Yeah,
Yeah, that'd
unfortunately.
be great.
That's a good question. I'll pose it to my tax team. I've always said no. I'll pose it to the tax team. Um, because technically the aggregate stays under um 7 days. So I will ask. I'll get you an answer, Tyler.
Mm, okay.
Um, Turning into a long-term rental. So when you do that, you're changing the use of the building. So it's going to go from a 39-year asset to a 27.5-year asset. Um, yeah, personally, I don't think I would say in that situation the cost seg's fine to do because realistically you don't have to change it from 39 to 27 and a half because you're taking a more aggressive you're taking a less of a benefit. So you're adding 12 years to your depreciable life. The IRS isn't going to say the IRS isn't going to say, this is you're taking the wrong depreciation because they're paying you less money every year. Um, yeah. Yes. Yeah, I really don't know how hotels work, but yes, the 500 hours are tough, especially for a property like that. I don't, and what the, what the short-term rental loophole specifically talks about is homes, or I don't know if you would then have to prove 500 hours for every single door, which would be insane. It wouldn't even be feasible. So, um, yeah, the 500 hours would still have to be met unless you have real estate professional status.
Awesome.
But I will get you an answer from our tax team.
This is fantastic. Do we have any other questions? All right. It's silent. There's been a lull. But that's okay. If you do have questions, yeah, we're gonna get our contact info out to all of you guys. Um, so yeah, would love to actually speak with some of you on a more individual basis because you guys brought a lot of good questions to the table. But yeah, I think that unless you've got any closing remarks, Connor, we can wrap things up.
No, I'm good. I appreciate everybody for being so active. That makes it so much easier to keep the flow of a presentation going. So I appreciate it. They were great questions. Um, Two that I have to go to our tax team for. So it's rare that I don't know the answer, but um, great job.
Gotcha. All right, everyone. Well, have a wonderful day and thank you for joining. Yeah, we'll talk soon.
So appreciate it, everybody.
All right.